Welcome, today we'll be looking at 5 undervalued stocks for May 2025. So let's jump straight into it. Starting off with Texas Roadhouse, ticker symbol TXRH, which is in the restaurant industry, and this company had a very good 2024 with a very nice run up from September all the way to December. However, starting 2025, the stock has lost all the ground that it had gained in that year, and it is now only 1% up in the past year. We can see that the company is trading at the lowest price to earnings that it has been trading at for the past 4 quarters, currently sitting just above 24 PE ratio. And when it comes to their price to cash flow ratio, this has been a lot more stable, and it is trading at around 16 times. Now, perhaps the greatest factor for this company's stock growth has been their consistent dividend, which has been growing at a 3-year dividend CAGR of 27%. And as we can see has been rock solid, stable, and they currently have a 1.55% dividend yield, which is not bad, especially when you consider that dividend growth rate. And when we look at their financials, we can see that on the one hand, their top line has been improving pretty rapidly, and on the other hand, despite this being a low margin sector because it's restaurants, they cannot have very high or tech sector margins. However, we can see that these have been fairly stable, with their net margin currently sitting at around 8%. The greatest asset that this company has is their free cash flow generation though. However, in the 2 quarters prior to the latest one, this has not been shown. As we can see that in quarter 1 and quarter 4 of 2024, they had astonishing free cash flow generation, but in the quarters in the middle of the year, this was a lot lower, mainly because they were investing a lot in order to conduct their expansion, opening new restaurants, and just investing in their overall business. Now, in my opinion, I would like this company to show a bit more stability, especially in that generation, because it is the thing that is allowing them to grow their dividends at a 27% CAGR and to attract a lot of powerful investors. And last but not least, when we look at their leverage evolution, we can see that yes, their total assets have been rising, but they have been rising at a faster pace than their total liabilities, which has managed to keep their current ratio at a very stable level, which is good for their financial stability. Company number 2 is Blackstone. And although this company is not trading at around their 52-week lows, I'm including them here because they have been trading downwards for a very long time. And we can see that this company's stock price followed a very similar trajectory than Texas Roadhouse. They had an amazing 2024, and the moment 2025 started, then the stock has been suffering ever since, with their valuation ratio and their price to earnings ratio sitting right below all of the previous quarters. However, this stock trades at a higher premium at a PE ratio of 42 times. Now, this company does pay a dividend, and they currently have a 3% dividend yield, which is not bad. However, we do have to consider something interesting, which is that in the past 3 years, the growth rate of this dividend has been negative, growing at a negative 1% 3-year CAGR. And this, from what I have been hearing about from the industry, has to do with the fact that 2024 and 2025 have not been the best years for private equity and investment management companies, which can partly be seen in their financials. Now, one thing that I don't like about Blackstone is that they don't have very consistent financials. As every investment management firm, they excel in quarter 4 2024 as they carry most of their fees and they conduct adjustments in order to improve their numbers right at the last quarter of the year. This is tricky because it doesn't let investors actually know exactly how well the business is performing. There is a little bit of engineering behind the numbers from these companies. One thing to note, however, is that this actually causes for their net margin to be rock solid. And now when we look at their free cash flow evolution, we again do not see that stability that we look for in companies. They have had brilliant quarters and they have had okay quarters, but this is not related at all to their revenues and income evolution, which raises the question on how focused on free cash flow is this company. However, when we look at their leverage evolution, their total assets are sitting above their total liabilities, and they have been doing so for the past year, which reports a solid financial situation for this company. Now, before we move on, remember that all the graphs we're showing here are actually offered by TradingView, and if you're interested in joining, you can join with the link that you can find down below, where you will get a pretty good discount on your subscription. Now, next is Marvell Technology, which is in the semiconductor industry, and this company is down over 14%, but if we were only to take the year-to-date return, this company is closer to a 40% downturn on their stock price. One thing to note about this company is that the trailing 12-month financials or net income have not yet been positive, which is the reason why they don't currently have a price to earnings ratio. However, if we were to look at the price to cash flow ratio, despite the stock price actually decreasing by a lot, this price to cash flow ratio has increased, meaning that even though the stock apparently has gotten cheaper, if we look at it from a free cash flow perspective, it has actually gotten more expensive because their free cash flows have decreased over the quarters. But we will see that in the next slide. Now, another interesting dividend situation, this company, their dividends have been very stable every single year, paying the exact same amount, not growing a bit. However, they are yielding a 0.41% dividend yield, but I'm not sure that they have a clear dividend strategy, and I honestly don't understand why they are paying dividends and have been doing so for the past 4 years when they're still at negative net income territory. However, one good thing to note about this company is their top line evolution. This has been amazing, and we can see that the latest quarter was their first ever net income positive quarter. Of course, their trailing 12-month net income is still negative, but this is a very positive sign for the near future for this company. This, of course, has made their net margins increase a lot because they were coming from a negative territory, and we will have to see where they go from here. I'm guessing that they will keep increasing their profitability while expanding their top line, which is great and is how it should be done. But the thing that I most like about this company is that extremely consistent cash flow evolution. This gives investors security, and it actually allows you to kind of predict or estimate where more or less their free cash flow generation will be on the following months. For example, in this case, there is a very high chance that in the following couple of months, their free cash flow will not be lower than 240 million. And most likely, unless something very weird happens, their free cash flow will be above 400 million. However, we have to remember that past results don't actually dictate future performance, but this is the security that a consistent free cash flow company actually gives investors like me, and that is why we actually look for that. But another positive thing is their leverage evolution, with their total assets actually staying very stable and their total liabilities not moving an inch. Additionally, they have over 3 times their total assets and their total liabilities, meaning that they won't have to worry about that anytime soon. Next stock on the list is Deckers Outdoor, which is in the footwear industry, and this company has been facing a very rough time ever since the day that Trump announced his famous tariffs. This is because a lot of the sales that these footwear companies such as Deckers, Crocs, Nike, Adidas actually sell are done with China. And with the huge tariffs with China or to the outside world, this is actually making business a lot more difficult for these companies. Now we can see that prior to that announcement, if we just try to ignore that huge drop in price, we can see that their valuation had been fairly stable, with their price to earnings ratio trading at around 30 times and their price to cash flow ratio at a bit lower, but very consistent throughout the quarters. Now we do have to remember that this company does not pay a dividend, but their top line had been improving at a very fast pace in 2024, with quarter 3 2024 being their highlight quarter, as we can see that every single financial metric improved, even their net margins, which had been extremely consistent at above 15% for the whole year. And the one bad thing that I can see here is that yes, they had free cash flow in that quarter of above $1 billion, which is insane. However, they are not consistent at all with this generation, as the 3 quarters prior to that had basically generated zero free cash flow, and in some cases the free cash flow was actually even negative. However, when we look at their leverage evolution, again, this company has over twice the total assets than total liabilities, and despite their liabilities increasing at some point in time, their total assets are increasing at a faster pace. And last but not least, we have the United Health Group, which has been included in these lists a lot of times. This company goes through very big ups and downs, and it's currently sitting way below any other price point that it has been sitting at for the past year. Now, this is because the company experienced a one-day over 20% price drop because they assured that the medical expenses for their insurance lines was going to be a lot higher than they expected. This just means that they will have a lot higher cost than what they actually believed they were going to have. This has to do with inflation, with a lot more clients actually having health issues than they calculated, and other factors that were very hard to predict. When we look at their valuation ratios, we can see that a year ago, this company was trading at a way higher premium than it is right now, as they were trading at a price to earnings ratio above 30 times, and now they're closer to 20 times. And after this huge decrease, well, this is much lower. However, one positive thing that UNH had going for them is their amazing dividend, which has been growing at a 13% 3-year CAGR, and they're currently yielding a 2% dividend yield, which is great for a company of this quality. I've stated this before and I'll state it again, I don't like their business model at all. We can see that despite their revenues growing at an okay pace, they have tiny margins, which means that there is almost zero wiggle room for errors in their calculations of the premiums, for operating expenses increases like the ones that they announced a week ago, and just to generate shareholder value at all. This, on the one hand, makes their business be very risky when in a high inflation environment, and on the other hand, actually makes it very hard for them to actually generate high and consistent cash flows. As we can see, their cash flows are all over the place, and when we compare to their top line, they're just not significant enough. Which raises the question of how sustainable the dividend actually is, but they have been paying it for a long time, so I will keep that conversation in store. A good thing that this company has is that their liabilities are way below their total assets, and they currently have this under control. However, I currently would not feel comfortable owning United Health Group as it has had a very rough couple of years. It's under the spotlight. Consumers are not a big fan of it. They only choose it because it's the only option. And the rising medical and healthcare costs are eating away at their business model, and they're currently having a hard time actually monetizing and actually making decent profits out of their current business model. But having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I will see you in the next one.